Welcome back to the Deep Dive. Usually when we talk about wars in the business world, we're talking about things you can see. Coke versus Pepsi on the supermarket shelf. Ford versus Ferrari on the track. Apple versus Samsung, right there in your pocket. These are brands fighting for your attention in the physical world.
Right. They're visible, tangible conflicts. You see the ads, you see the products. It's visceral.
But today, we are talking about a war that is completely invisible to, I'd say, 99% of the population.
Oh, easily.
It's happening in the milliseconds between when you click a link and when the page loads. It's a war for the plumbing of the internet and the combatants. On one side, you have the empires, the walled gardens, Google, Amazon, Meta.
The giants.
And on the other side, you have the rebellion, what they call the open internet.
It sounds dramatic when you put it that way, but honestly, looking at the source material we have today, the Q3 2025 financials, the transcripts from CEO Jeff Green, the technical breakdowns of their new AI, Kokai, that is exactly what this is. It is an existential fight for how the internet is funded and really who controls the flow of information.
And leading this rebellion is a company that, frankly, most people outside of finance or ad tech have never even heard of, the Trade Desk, ticker symbol TTD.
They're the biggest company nobody knows. I mean, if you're watching Disney Plus and if you're listening to Spotify, if you're reading the New York Times online, the Trade Desk is very likely the engine deciding which ad you see.
Right.
They are the broker for everything that isn't Facebook or Google search.
But the reason we are doing this deep dive today is that the battlefield has shifted.
Right.
Radically. For a decade, the Trade Desk was the darling of Wall Street. They were the Google killer. They were the growth stock that could do no wrong.
Right, just up and to the right.
But now they're facing a new archenemy, one that has deeper pockets, more data, and a terrifying willingness to lose money just to kill a competitor.
Amazon.
The everything store wants to be the everything ad platform, and they have a weapon that the Trade Desk might not be able to defend against. The price tag. The Trade Desk charges a 20% premium fee.
Yep.
Amazon is coming in and saying, hey, we'll do it for free, or close to it.
It's the classic predatory pricing strategy, and it raises the central question of this whole deep dive. In a world of commoditized tech, is neutrality worth paying a 20% tax for?
Exactly.
Or will the open internet eventually just become another subsidiary of Amazon?
So we have a lot to get through. We need to unpack this war mode strategy. We need to look at this new AI, Kokai, which claims to be a game changer, but had a pretty rocky start.
Definitely.
And we need to look at the financials to see if this company is a generational buy or if it's a falling knife. So let's start with the landscape.
Let's do.
Okay, section 1, the landscape. Before we get to the shooting war, we have to understand the terrain. We keep saying DSP, demand-side platform. In the notes, you compared this to a stock trading terminal, but I feel like that simplifies it a bit too much.
It's the best starting point to visualize it, I think. Imagine you are, say, Nike. You have a budget of $10 million to sell a new running shoe.
Right.
You cannot possibly call up every website, every app, and every streaming service to negotiate ad space. There are literally millions of them. The market is just, it's incredibly fragmented.
You'd need an army of people on telephones, like in the old days.
Exactly. So you use a DSP, like Trade Desk, as your Bloomberg terminal for ads. You log in, you set your parameters. I want males 18 to 34 who like marathons, and I want to reach them on connected TV and premium news sites. The DSP then plugs into the global ad exchanges.
And this is where it gets crazy. This isn't a manual negotiation. It's not people making deals.
No, not at all. It's high-frequency trading. Every time a user loads a web page or opens an app, an auction happens. We are talking about roughly 100 milliseconds.
A blink of an eye.
Less than that. And in that blink, the DSP analyzes the user, values the ad slot, bids on your behalf, and if it wins, your ad shows up. It does this millions of times a second across the globe.
So it is high-frequency trading for eyeballs.
That is precisely what it is. And for years, the Trade Desk has been the premium version of this tool. They operate as an independent DSP. They don't own the websites. They don't own the streaming services. They just buy the space. And for that service, they charge a take rate of roughly 20%.
Okay, pause there. 20%. In the world of fintech, right? Fees are racing to zero. You can trade stocks for free on Robinhood. You can send money for free. In ad tech, TTD has somehow maintained this 20% rate for years. That feels like a massive tax. How do they justify that when Google offers a similar tool for less?
This brings us to the core philosophy of their entire business model: objectivity. The walled garden problem.
This is the grading your own homework concept that Jeff Green, the CEO, talks about constantly on every earnings call.
Precisely. Let's look at Google. Google owns a huge amount of ad inventory. YouTube and search are the big ones. They also own the DSP. It's called Display and Video 360.
Right.
So if you go to Google's DSP and ask, where is the best place to put my money? Google's algorithm has a massive, glaring conflict of interest.
Of course.
It is financially incentivized to tell you, you should put it on YouTube because Google keeps 100% of the money there. They get both the tech fee and the media revenue.
It's like asking a real estate agent which house to buy, but the agent also owns half the houses on the block. They're not going to show you the other side of town.
Exactly. They will steer you toward their own inventory, and the data shows they have done this historically. The Trade Desk's entire pitch, the reason for being, is we don't own anything. We don't own a streaming service. We don't own a website. We don't care where you buy, as long as it works for you, the advertiser.
So their incentive is completely aligned with the buyer. Find the best ad slot for the best price, not find the ad slot that pays us the most rent.
That's the theory. And that objectivity is why they have come to dominate what they call the open internet.
Let's define that term too, because I think people hear open internet and they think of, I don't know, old blogs from 2005, but this is a massive, massive market.
It's huge. The sources peg it as a $935 billion opportunity. It's everything outside the walls of social media and search. So it's not Facebook, it's not Instagram, it's not Google search, and it's not TikTok. The open internet is streaming TV, so connected TV, or CTV, is king here.
And looking at their revenue mix from the Q3 report, that's the biggest chunk, right? By far.
Yes. Video and CTV make up about 50% of the Trade Desk's revenue. That's Disney plus Hulu, Peacock, Paramount plus Max, all the big premium streamers. Then you have mobile, which is in the low 30s.
Okay.
And then display, banner ads and audio like Spotify and podcasts, which are smaller but growing, making up around 5%.
Jeff Green, the CEO, he had a really interesting metaphor for this neutrality in one of the transcripts we looked at. He talked about the difference between the delivery truck and the package.
Yes, the Amazon delivery versus Amazon product metaphor. It's a great one. He said, look, there's a difference between the Amazon delivery service, the truck that brings you the box, and the Amazon product, the actual thing inside the box. Just because they both have a smiley face logo doesn't mean they are the same thing or that one is dependent on the other.
Meaning, don't confuse the tool that buys the ad with the ad space itself, the logistics versus the goods.
Exactly. He's trying to teach the market that you shouldn't confuse the logistics with the goods. He wants the Trade Desk to be the best, most objective logistics company in the world. But this is where the war starts, because Amazon is now saying, sure, maybe we have a conflict of interest, but does it matter if we're 20% cheaper?
And that segues perfectly into Section 2, the new archenemy. We have talked about Google for years. Google has been the big bad wolf of ad tech forever. They have 47% market share. They're the behemoth. But suddenly, looking at the transcripts and the analyst reports, everyone is talking about Amazon. Why the sudden shift in focus?
Because while Google is the entrenched giant, Amazon is the urgent threat. Amazon has decided to go to war on price. This is what all the analysts are calling the pricing war.
Let's drill down into this.
Right.
Because in the source material, the analysts are, well, they're freaking out about this. This isn't just normal competition. The language they use is scorched earth pricing.
It's a pricing dislocation. I mean, it's a fundamental break in the market's structure. Amazon is reportedly offering their DSP fees as low as 0% to 1% if you do what they call programmatic guaranteed deals.
Wait. 0%. How is that a business? How do you pay your engineers and run massive server farms if you charge 0?
It's not a business. Not for the DSP unit anyway. It's a loss leader. Think about Amazon's flywheel. They don't need to make a profit on the ad buying tool.
Right.
They make their profit when the ad works and you buy the product on Amazon.com. They take a seller fee, a fulfillment fee, a shipping fee, or they make money on the media subscription for Prime Video if you saw the ad there. The DSP is just a means to an end.
So the ad tech tool is just the gateway drug. It's the free sample to get you into their store.
Correct. They can subsidize the tool to 0 because they capture the value elsewhere in their massive ecosystem. The Trade Desk cannot do that. Their only product is the tool. They have to charge roughly 20% to keep the lights on and pay their world-class engineers.
That is a terrifying structural disadvantage. It's like a local bookstore trying to compete with Amazon books in 1999. You're going to have better service, better recommendations, better coffee. But if the book is half price across the street, you are in serious trouble.
And we are seeing the impact of that already. The notes highlight what they call market share bifurcation. We are seeing reports of major holding companies, these are the giants like Omnicom and WPP that control billions in ad spend, starting to shift budgets to Amazon specifically because of this price pressure.
Because if I'm a CFO at a big agency or at a brand and I see 20% fee on one invoice versus 1% fee on another, that's an immediate 19% efficiency gain on my spreadsheet.
Yes.
I don't care about philosophy or open internet ideals as much as I care about that 19%. That's a huge number.
Exactly. Even if the trade desk's tech is better, and we'll get into whether it is it 19% better, that's the very difficult math problem every agency is trying to solve right now.
And Amazon is twisting the knife. It's not just about price. It's about the inventory they're selling. This Trojan horse aspect, where Amazon is now selling Disney Plus ads. I saw this in the notes, and my jaw literally dropped.
This is the part that really, really threatens the trade desk's core narrative. TTD used to be able to say, the walled gardens are for user-generated content, cat videos and influencers. If you want premium TV, Disney, Netflix, HBO, you have to come to the open internet, and we are the main toll booth.
But now Amazon has partnered with those guys. They've built a gate in the wall.
Amazon has cut deals to be the reseller for Disney, for Roku, for Netflix's ad tier. So now Amazon goes to the advertiser and says, we have the same premium TV shows you want, but if you buy them through us, it's cheaper, and we'll overlay our incredible first-party shopping data on top of it.
That is a brutal, almost unbeatable sales pitch. Same show, better data, lower price.
It's a very dangerous pitch. And this is why the trade desk is in war mode. They aren't just coasting on growth anymore. They are fighting for their existence as a premium standalone company.
So, the trade desk is backed into a corner. They cannot win a price war. They will die if they try to match 1%. So they have to win a performance war. They have to prove that their tech is so good, it pays for itself and then some.
Exactly.
This brings us to Section 3, the weaponry. Kokai.
Kokai. It sounds like a warrior's name, which is fitting, but the source material says it's Japanese for open waters.
Very on brand for them.
Very. Kokai is the trade desk's massive platform overhaul. It's their answer to the pricing war. And to understand why this matters, we have to talk again about the sheer scale of the open internet today. We are talking about 20 million ad impressions per second.
20 million per second. That number is just, it's hard to even wrap your head around.
It is a data fire hose. The old way of doing ad tech was having a central brain, a primary algorithm that would look at a bid request, evaluate the user, evaluate the price, and make a decision. But at 20 million times a second, a central brain gets bottlenecked. It can't keep up.
It's too slow. By the time it decides, the auction is over and the opportunity is gone.
Or it has to use shortcuts. It has to use simple heuristics instead of deep, nuanced analysis. Kokai changes this by moving to what they call distributed AI.
Break that down for us. Distributed AI, how is that different from just, AI?
Well, imagine the human body. Your brain doesn't consciously control every single heartbeat or every muscle twitch when you trip on the sidewalk. You have a nervous system. You have reflexes that are distributed through your body.
Okay.
Distributed AI pushes the decision-making out to the edges of the system. They have thousands of specialized models for everything. One deep learning model just looks at the image quality of the ad slot. Is it cluttered? Is it above the fold? Another model just looks at the supply path. Is this the cheapest, most efficient route to buy this specific ad slot? Another looks at the user identity signal.
So instead of one genius trying to do it all, it's a swarm of specialists all acting instantly and in concert.
That's a perfect analogy, and this allows them to process that fire hose of data much faster and crucially more accurately. And this is how they defend that 20% fee. Their argument is, sure, Amazon charges 1%, but if Amazon's less sophisticated algorithm buys you a junk ad slot that nobody sees or buys it at the wrong price, you just wasted your dollar.
Right.
We charge 20%, but our distributed AI is so smart that we get you the perfect slot at the perfect price, and your campaign performs so much better that you actually save money overall.
You get what you pay for. But do they have the numbers to back that up? Or is this just marketing hype? Because every tech company says they have AI now. It's on every press release.
The early read on Kokai is very strong, at least according to their internal data published in the reports. The sources cite a 26% improvement in CPA, that's cost per acquisition.
Okay, pause on that number. 26% improvement in CPA. That is the magic number.
Why you say that?
Because their fee is 20%. If they save me 26% on the performance, meaning I get more customers for less money, the fee pays for itself. and I'm still up 6%. The service is effectively free, or better than free, because of the efficiency gain.
That is exactly the math Jeff Green is banking on. That is the entire bull case for the company. He calls it the independence dividend. If the tech is good enough, the fee becomes irrelevant. They also claim a 58% better cost per unique reach, which is huge for brand advertisers, and a 94% better click-through rate.
94% better CTR. That is almost double. That suggests the AI really is finding people who actually care about the ad, not just serving into the void.
It does. And there is another feature in Kokai that the sources highlighted called the deal desk. This addresses a huge inefficiency in the traditional TV market.
Right, the upfronts, where everyone gathers in New York.
Yes. For decades, TV advertising has been bought in the upfronts. Big brands like Ford or Procter & Gamble commit millions of dollars months in advance to reserve ad slots on TV shows for the upcoming season. It's historically been very manual. Handshakes, martini lunches, and giant spreadsheets.
Sounds fun, but incredibly inefficient. You're locking in millions of dollars without knowing if the show will even be a hit or a flop.
Exactly. It's basically gambling. The deal desk in Kokai brings data-driven decision-making to that whole process. It allows buyers to use AI to forecast how those ads will perform on different shows before they sign the multi-million-dollar contract.
So I can simulate my $1 million buy before I spend the $1 million. I can see what my likely reach and frequency will be.
Essentially, yes. It brings the precision of programmatic advertising to the big, reserved, upfront contracts of the TV world. It's a massive value add for those big advertisers. It de-risks their largest budget item.
That sounds like a game changer. But, and the sources highlight a big but here, deploying this was apparently a nightmare. The sources mention deployment friction and operational headaches a lot.
Yes, we cannot gloss over this. The rollout of Kokai in late 2024 and early 2025 was not smooth at all. Agencies, their clients reported bugs, broken integrations with their own internal systems, workflows that were suddenly much more complex.
Imagine you're an ad buyer at a big agency. You're trying to spend $10 million for your client, and the button doesn't work, or the report doesn't load. The pressure must have been immense.
It caused a lot of headaches. And frankly, it gave Amazon a huge opening. In a war, frustration is dangerous. If your premium 20% tool is buggy, that Amazon 1% tool starts looking a lot more attractive.
Right. Hey, it might not be as smart, but at least it works and I can go home on time.
Precisely. It creates churn risk. But the update here is that they seem to be through the worst of it, according to the latest management commentary.
What are you saying?
Management reports about 85% adoption of Kokai as of late 2025. That suggests they have mostly weathered the storm and fixed the major bugs. But it was a rocky road, and it shows the incredible risk of doing a massive platform overhaul while you are under intense competitive fire.
Okay, so Kokai is the software defense. But the trade desk is also making moves in the physical world, or at least the supply chain of the physical world.
Yeah.
Section 4, securing the supply chain. They were launching an operating system, Ventura OS. This one seems to come out of left field.
This is a bold move. Maybe their boldest strategic move in years.
Why does an ad tech company need to build an OS for a TV? That feels like getting into the hardware business. That feels like a low-margin, messy, complicated business.
It's not about the hardware margins. It's about controlling the gatekeeper. Look at who controls the living room right now. Roku, Amazon Fire TV, Google TV, Apple TV.
All direct competitors?
All direct competitors and walled gardens in their own right. If you own the OS on the TV, you control the glass. You control the user experience. You can control which ads get shown. You can control the data. You can block other people from tracking. You are the toll booth for the living room.
I see.
The trade desk realized that if they don't have a foothold in the OS layer, they could eventually be shut out completely from the most valuable ad inventory there is, the living room TV.
So Ventura OS is what?
Yeah.
A kind of neutral, open-source TV system, like Android for TVs, but not run by Google.
Exactly. The pitch to the TV manufacturers, the people who actually make the screens, like Sharp or Hisense or TCL, is this. Look, Roku and Amazon are taking all your ad money. They treat you like a commodity box for their software. Put Ventura OS on your TV. We will give you a better cut of the ad revenue, and we won't prioritize our own content because we don't have any.
That is clever. It's appealing directly to the hardware makers who have been getting squeezed by the software giants for years. It's an alliance of the underdogs.
It's a hardware layer play to secure a neutral path to the inventory. If TTD powers the OS, they ensure that the open internet stays open in the most important room of the house.
Then there is retail media. That's another huge piece of the puzzle. We talked about Amazon having all that shopper data. They know I bought diapers and dog food yesterday. That is the ultimate signal for an advertiser.
It is the gold standard. It's what the industry calls determinism. I don't have to guess. I know you bought it.
So how does the trade desk compete with that? They don't have a store. They don't have a shopping cart. They don't have a warehouse.
They borrow one. Or, more accurately, several. This is their partnership strategy. They've partnered with the biggest retailers in the world who aren't named Amazon: Walmart, Instacart, Target, Kroger.
The enemy of my enemy is my friend strategy.
Precisely. Walmart hates Amazon. Target hates Amazon. They all have tons of valuable shopper data, but they aren't tech companies. They don't have the engineering talent to build a world-class DSP from scratch. So the trade desk comes in and says, let us be your ad tech engine. We will let advertisers target using your data on our platform.
And this leads to closed-loop attribution. This term came up a few times in the source docs. Can we explain that in plain English?
It's a holy grail of advertising. It means linking an ad view directly to a physical in-store purchase. Here is the loop. You're at home. You see an ad for Tide laundry detergent on Hulu, which was bought through the trade desk. 3 days later, you walk into a Walmart and buy that laundry detergent at the checkout.
Usually, those two events are completely disconnected. The TV doesn't know what I did at Walmart, and Walmart doesn't know what I watched on TV.
Right. But because of the partnership, the trade desk can connect those two events.
Yeah.
They can match the identifier from the TV ad view with the identifier from the Walmart checkout data. And they can go back to the advertiser, Procter & Gamble, and say, it worked. That ad we showed on CTV directly caused that sale in a physical store.
That neutralizes Amazon's biggest data advantage. Amazon's whole pitch is, we know they saw the ad on Prime Video and then bought it on Amazon.com. TTD is now saying, we know they saw the ad on Disney Plus and then bought it at Walmart, Target, and Instacart.
It does. It aggregates the data from everyone else to fight the singular data advantage of Amazon. It's a coalition strategy.
And finally, in this section, briefly, UID2, Unified ID 2.0. We have talked about this before on other deep dives. The cookie is dying.
The cookie is crumbling. Google keeps delaying it, but the writing is on the wall. Third-party cookies are going away. Apple already killed them on Safari. This makes tracking people across the web for advertising purposes very, very hard.
So how does UID2 fix that?
UID2 is the trade desk's proposed alternative. It's an open-source identity framework. Instead of a cookie, which is a little file that a website drops on your browser, it uses your email address as the starting point.
Okay.
When you log into a streaming service or a news site with your email, that email is encrypted and turned into a token, a UID2. It's anonymized, but it's consistent.
So it's a way to track people anonymously across different sites and apps without relying on Google's cookies or Apple's IDFA.
Correct. It's about creating a common currency for identity on the open internet that isn't controlled by a walled garden. If everyone in the open internet ecosystem adopts UID2, advertisers can still target you effectively across different devices without needing Google or Facebook to help them. It's an infrastructure play.
Okay, so they have the weapons. They have Kokai, they have Ventura, they have the retail data, they have UID2. But how are they actually doing in the war? Let's look at the scoreboard. Section 5, Financial Health, Q3 2025. Give us the top line numbers.
Revenue for the quarter, $739 million. That's up 18% year over year.
18%. In a vacuum, that sounds great. Most companies in the S&P 500 would kill for 18% growth. But for TTD, that's a different story.
It is a deceleration. That is the key word the market is focused on. This is a company that used to grow at 25%, 30%, even 40% in its heyday. The market looks at 18% and gets very nervous. It suggests the hyper-growth phase might be over. It suggests the law of large numbers is kicking in, or
the Amazon competition is starting to bite.
That's the fear.
There was a nuance in the report about political spend, though, right? 2024 was a major election year.
Right. Political spending is lumpy. It floods into the market every 2 or 4 years and then disappears. If you exclude that political spending to get a cleaner apples-to-apples comparison, the growth was more like 22%.
Okay, so it's a bit better than the headline looks, but still.
Yeah.
It's not the rocket ship it was 3 years ago.
It is not.
And profitability. Because usually when growth slows, you want to see profits and cash flow go up as the business matures.
And they are. Their adjusted EBITDA was $317 million. That's a 43% margin. This is massive. This is not a growth at all costs tech company that burns cash. They are an absolute cash machine. They are incredibly disciplined financially.
And they are putting that cash to use. The buybacks were a huge number.
They are buying back their own stock aggressively. The notes say nearly $1 billion was repurchased year to date in 2025.
That is a very strong signal. That tells me management thinks the stock is undervalued. They are putting their money where their mouth is and buying up their own shares on the open market.
Exactly. And speaking of value, the stock has taken a big hit. Because of these deceleration fears, it's trading at, 18 to 21 times forward earnings.
Which, for a tech company of this quality and profitability, is surprisingly low. This is a stock that used to trade at 50 times, 60 times, sometimes close to 100 times forward earnings. The multiple has been compressed dramatically.
So this creates the whole falling knife versus generational buying opportunity debate that the analysts are having. If you believe the Amazon threat is manageable, and this is a temporary slowdown, then this is a fire sale on a premier asset. You are buying the Google of the open web at a significant discount.
But if you believe Amazon is going to fundamentally break their business model,
Then it's a classic value trap. It looks cheap, but it's just on its way to getting cheaper. Or at least it's going to stagnate for a very long time.
let's look at that bear case, the negative view, a bit more closely, because we need to be objective here. What are the critical risks that could really derail this company?
The biggest one, the one that hangs over everything, is take rate compression,
The fee.
the 20% fee. The bear case says that no matter how good Kokai is, no matter how nice the user interface is, you simply cannot charge 20% when your biggest, most aggressive competitor is charging 1%. Economics is like gravity. Eventually, it pulls you down. The argument is that the trade desk will inevitably have to lower its fee to 15%, then 10%, just to stay competitive.
And if they do that, their revenue collapses and their 43% EBITDA margins get absolutely crushed. The whole financial model breaks.
Exactly. It's the commoditization of the market. Ad buying just becomes a commodity, like electricity. You don't care who provides the electricity, you just want the cheapest plug. If ad tech becomes a commodity, TTD loses its premium status and its premium valuation.
What else is on the bear list?
Google's shadow. It never really goes away. Google still has 47% market share. And there is a fear, paradoxically, that if antitrust regulators finally win their case against Google, it could actually hurt TTD.
Wait, how does hurting Google hurt TTD? I thought they were enemies. That seems counterintuitive.
They are. But right now, Google is arguably holding back a bit on the open internet. They steer a lot of ad traffic to their own property, YouTube, because they are allowed to. If regulators force them to divest the ad tech business or force them to compete more fairly, a newly independent Google DSP might actually start competing much more aggressively on the open web. And Google, like Amazon, is also a low-cost provider.
So they could get squeezed from both sides. Amazon from below on price, and a newly unleashed competitive Google from above. That's a tough spot.
And finally, the macro factors. The sources talk about a tale of two cities in the ad market. Large global brands are being very cautious with their budgets because of inflation, supply chain issues, and tariffs. Those large brands, the Procter & Gamble's, the Ford's, the Unilevers, are the trade desk's bread and butter. If they catch a cold, TTD gets pneumonia.
So we have a defensive war, a pricing squeeze from a trillion-dollar company, and cautious customers. It's not an easy road ahead. Which brings us to Section 6, the final verdict, turnaround or trap.
This is where we have to synthesize everything we've talked about.
Let's lay out the arguments clearly. Give me the trap argument first. Why is this stock a falling knife?
The trap argument. Amazon is simply too big, too cheap, and has too much proprietary data. The Trade Desk is a niche player that is destined to be squeezed out. Their 20% fee is a relic of a time when they had no serious competition. They owe the BlackBerry and an iPhone world great tech for a while, but ultimately crushed by a more powerful, integrated ecosystem play. Price will win.
Harsh, but definitely plausible. Now give me the turnaround argument, the bull case. Why is this a generational opportunity?
The independence dividend. The bull case says that advertisers need a neutral, objective party. P&G and Coca-Cola do not want to be beholden to Amazon and Google for everything. They do not want to give Amazon all their campaign data. They want an open, transparent marketplace. And crucially, Kokai's performance, that 26% CPA improvement we talked about, proves that the 20% fee actually pays for itself.
It's the Intel inside argument.
Exactly. You paid a premium for the Intel chip because it makes the whole computer run better and faster. Jeff Green wants TTD to be the Intel inside of advertising. If they can continue to prove that their sophisticated AI yields better outcomes, better ROAS, return on ad spend, then the fee is justified and they win on performance, not price. And looking at the massive buybacks and the 85% adoption of Kokai, management seems confident they can win this fight.
But the reality is they are in war mode. This is no longer the easy hyper-growth story it once was.
No. Not at all. They have to execute perfectly. The operational chaos of the Kokai rollout in Q4 2024 cannot happen again. The AI has to work flawlessly. Ventura OS has to get adopted by TV makers. They have to fight for every single inch of market share every single day.
So what does this all mean for you, the listener? Even if you don't buy ads, even if you don't own the stock, why should you care about this invisible war?
Because it determines the future of the internet you use every single day. If the trade desk loses this war, the open internet as we know it likely shrinks. We move much closer to a world dominated by three walled gardens: Amazon, Google, and Meta. The content you see, the news you read, the diversity of voices online. So much of that is sustained by open web advertising.
If the independent funding mechanism dies, the independent content might just die with it.
Precisely. It's about whether we have a diverse, messy, sometimes chaotic but open web, or a curated, corporate, walled web where three giant companies decide what you see, read, and watch.
That is a sobering thought. And I want to leave you with this provocation to think about. Jeff Green wants the trade desk to be the Intel inside of advertising. But in a world where Amazon owns the store, the delivery truck, the TV you watch it on, and now the ad tech that powers it, is there even room for an independent chip? Or is neutrality a luxury that brands can no longer afford in a brutal price war?
It's the question every chief marketing officer at every major brand is asking themselves right now, and the answer will decide the winner of this war.
Indeed. We will be watching the battlefield closely. Thanks for listening to The Deep Dive.
Thanks for having me.
See you next time.